This is CNN Vantage Point. I'm Philip Pro, Senior Investment Officer with CNN Wealth Management, and today's podcast will provide a market review and our current outlook for the month of November 2022. The Fed executed their fourth consecutive 75 basis point rate hike on November 2nd and took the Fed funds rate to 4%, a level not seen since early 2008. Inflation reduction remains top priority for the Fed. An October CPI report released on November 10th provided welcome news. Headline inflation increased at a 7.7% year-over-year rate. While elevated, this number was below its 7.9% estimate. Relatedly, core inflation increased at a 6.3% year-over-year rate, below its 6.5% estimate. Equities rejoiced with the cooler CPI report. On the November 10th release date, the S&P 500 index posted its best daily return since 2020, rising 5.5%. The potential for sharp equity reversals is one reason we maintain our neutral equity allocation. Overall, major equity indexes provided positive returns during the month. Surprising many, the international markets were the leaders. The MSCI Europe Asia Far East Index returned over 11% in November, and the MSCI Emerging Market Index jumped over 14%. In contrast, bond yields immediately declined following the CPI report, with longer-term bonds experiencing the largest declines. In November, the 10-year Treasury yield fell 42 basis points and ended the month at a 3.68% yield, while the 2-year Treasury fell just 13 basis points and ended the month at a 4.38% yield. That leaves the 2-year Treasury yield 70 basis points higher than the 10-year Treasury yield. The difference between the two yields, also known as the inversion curve, stands at its highest level in 40 years. Many economists consider the inversion curve a leading indicator of a recession. In November, the U.S. held its midterm elections, which resulted in the Republicans gaining control of the House of Representatives and Democrats maintaining control of the Senate. The elections had a minimal impact on financial markets. While politics can certainly impact financial markets, it's our belief that today's markets are most focused on inflation, central bank action, and economic activity. The U.S. bond and U.S. equity markets are signaling two different scenarios. On one hand, the bond market is signaling a recession via the inverted yield curve. On the other hand, the equity market is indicating a soft landing. We believe seasonality and technical factors helped equity markets during November, but we see those fading in early 2023. Growth is slowing. The ISM Purchasing Managers Index and the Leading Economic Indicator Index continue their decline. The Leading Economic Indicator Index currently sits at negative 2.7 level. Another key index is the ISM Manufacturing Index. Its November reading registered at 49%, the lowest level since May of 2020, the COVID era. Despite these signals, earnings have held up better than expected, albeit from levels guided lower throughout the quarter. We remain cautious because we're still facing a tightening Fed and inflation, although subsiding, remains high, and consumers will continue to feel its pressure well into 2023. We made slight changes to our portfolio in November. We did not reduce equities, but we did shift to a slightly more defensive posture. We trimmed our international exposure, taking advantage of its recent gains, and reduced domestic mid-cap. In both cases, we reallocated to domestic large value. This move increases our quality and dividend factors. Within fixed income, we reduced our market neutral position in favor of core fixed income to capitalize on a more attractive fixed income market. We expect to maintain our current positioning as the economy slows and the Fed's tightening continues to unfold. If you would like more information about our portfolio positioning and market thoughts, please contact any of our wealth management advisors. And if you like this podcast, we'd be grateful if you'd share it with your friends. Thank you for listening, and on behalf of our CNN Wealth Management team, we want to wish you and yours a happy holiday season.
Please note, views are subject to change based on market conditions and other factors. These views should not be construed as recommendation for any specific security or sector. Client portfolios may or may not be at the positionings discussed due to, but not limited to, distributions, tax management limitations, systematic purchases, etc. Some products are not FDIC insured or guaranteed, not a deposit or other obligation of the bank, not guaranteed by the bank, and are subject to investment risk, including the possible loss of principal amount invested, and are not insured by any other federal government agency.